There have been a lot of questions about the recent capital gains changes and how they may affect selling a cottage or investment property. Today, I will give you some examples so that you can decide whether they will affect you, and if so, to what degree. What I can assure you of is that most people, once they go through this exercise, come to the conclusion that the actual effect is none or much less than they had originally thought. So let's start. Let's assume two people jointly purchased a cottage many years ago for $200,000. Over the years, they made capital upgrades to the cottage to the tune of $100,000. They now have $300,000 invested in their cottage. The couple has decided to sell their cottage. For simplicity, let's say the final sale of the cottage after realtor and other fees is an even $800,000. And so their profit is $500,000. That's the final sale minus the cost to purchase and the upgrades they invested into it over the years. In turn, each will be required to claim $250,000 on their taxable income during the year the cottage was sold. In this case, the new capital gains rules will not affect them because they did not go beyond the $250,000 capital gain threshold to trigger the new rules. The couple will each pay tax on 50% of their capital gain. 50% of $250,000 is $125,000. Now let's assume the worst case scenario. Both are taxed in the highest federal tax bracket of 33%. This means that they would each pay $41,250 or $82,500 combined. I will explain in a moment why it is unlikely they will pay this much, but for now, I am using the worst case scenario. In this case, the couple will walk away with $717,500 or $358,750 each, which is their sale minus the federal tax. Please note that in each province, there's also likely to be provincial income tax as well. I will address this in a moment. Now, remember, this is all existing. The new rules never came into play in this scenario because the couple never individually profited more than the threshold to trigger the new rules. Now let's consider the couple sold that cottage for $1 million. In this case, their profit would be $700,000 jointly. That's $1 million, subtract the purchase price of $200,000 and subtract the work they did along the way of $100,000. In this case, their capital gain is $700,000 or $350,000 each. Now, here's where things change. Under the old rules, they would have each paid tax on 50% of the entire $350,000 or $175,000 of their profit. Using the same assumptions of the highest federal tax bracket of 33%, they would each pay $57,750 in tax or $115,500 combined. This means that after paying federal tax, they would walk away with $884,500 or $442,250 each. Remember these numbers because they're important. Now, under the new rules, they would each pay tax on $191,000 instead of $175,000. This is because their inclusion rate is 50% on the first $250,000, as already exists, but 66.7% on the remaining $100,000. If we assume that once again they are in the worst case scenario and are paying the highest 33% federal tax rate, that means that they will each pay $63,030 in federal income tax or $126,060 combined. In this case, the couple walks away with $873,940 or $436,970 each after paying federal tax. So, on a sale of $1 million, where the couple purchased the property for $200,000 and put $100,000 of capital improvements into it, and in the unlikely scenario they find the entire capital gain subject to the highest federal tax bracket of 33%, the difference in income tax is $10,560 combined or $5,280 each. This is the difference between walking away with $884,500 versus $873,940 jointly after the new federal gains tax is implemented. There are two important things to consider about my examples. First, I did not consider the provincial income tax implications. These vary by province and are at the discretion of the provinces, not the federal government. So it is important to see how these may or may not affect you. And second, I am assuming that each person was subject to the highest tax bracket of 33%. This is an important point because the only way this tax bracket would apply to the entire profit would be if each person already had income of over $247,000, like a job or pension payouts, before their capital gain is even considered. The 33% tax rate is only applied to income over and above income of $247,000. And frankly, this is highly unlikely, especially since most people sell these assets in retirement when their annual income is much lower. So the actual tax implications, although I use the worst case scenarios, would likely be less, given that most middle income households would not be earning two incomes of $247,000 each in the year they sold these assets. And as such, the actual tax amounts paid would most likely be lower than in my examples. I hope this helps to better understand how the new policy may or may not have an impact on the sale of a cottage or investment property that you or somebody you know owns. Please feel free to share this video with someone you know who has questions about the new capital gains rules. And please let me know in the comments if clarity is still required or if you found this helpful.